Greetings, everyone. This is the next installment for Accounting 3800. Just to review, last time we looked at the accounting equation, assets equals liabilities plus equity. We learned that assets can be cash or non-cash. They can be current or non-current, depending on whether they're available for use in the current year or in future years. And that increases in asset accounts are represented by debits in accounting entries. On the other side of the equal sign, we learn that liabilities can also be current or long-term, depending on when they're due, in the current year or in future years. We also learn that long-term liabilities may have current portions. So if you have a loan payable or a note payable and it's going to be due in installments, there could be an amount due in the current year and amounts due in future years. So a portion of it will be recorded as a current liability and a portion of it will be recorded as a long-term liability. And those increases are recorded as accounting credits, which makes sense because they're on opposite sides of the equation. Equity can be thought of in terms of both contributed capital and earned capital. Contributed capital consists of stock and paid-in capital, and increases are represented by accounting credits. Under earned capital, we have retained earnings. Retained earnings are a function of revenues, expenses, and dividends. So revenues increase retained earnings, expenses decrease retained earnings, dividends decrease retained earnings. On the contributed capital side, again, increases are represented by accounting credits. Over on the earned capital side, retained earnings the increases in retained earnings are also represented as credits. Revenues are increased using accounting credits, but expenses and dividends are increased by debits. And again, that should make sense because, again, revenues increase retained earnings. Expenses and dividends decrease retained earnings. So expenses and dividends have to increase in the opposite direction from revenues and retained earnings in order for that to be true. In terms of the financial statements, again, the accounting equation actually represents all of the financial statements. When we look at assets, liabilities, and equity, in their simplest form, we'll just highlight that. That's essentially your balance sheet. Okay. If we look at contributed capital and earned capital, this right here is like our statement of stockholders' equity. Revenues and expenses, this is the income statement. And so all of the financial statements are represented in the accounting equation. Even over here, when we look at just cash, I'll pick that one. Even when we look at cash, the statement of cash flows is represented because remember that in the balance sheet you see one single number for cash, but that represents the aggregate of all the individual transactions that occurred within the cash accounts. Therefore, if you were to look at the individual transactions that occurred in the cash account, you would actually be looking at a representation of the cash flow statement. So that's how that works. Okay? I hope if anybody has any questions, you'll certainly email me about that. So now let's go over here to a worksheet I put together, just so we can take a look at how this works. So again, I'm going to go back to using the pillow company example. I call myself the Heavenly Pillow Company. Our pillows are so soft and comfortable, you feel like you're sleeping in heaven. So first thing I want to do is, wow, we need so Carl gives cash to get this company started. So I give it $10,000 in cash. All right, in return, I get $10,000 in equity, contributed capital. Okay, so both of these are positive numbers. We've increased the cash account and we have increased contributed capital. The equation is in balance. 10,000 equals 10,000. In addition, we have a long-term loan for $50,000 in cash. Oops, there we go. $50,000 in cash. That's going to show up as a long-term note or loan payable. Notice that the accounting equation is still in balance. We've got $60,000 in assets, and we've got $60,000 in liabilities and equity. Suppose I have sales that occur. All those sales are in, say, receivables. And so I have sold $25,000 worth of pillows. That's going to show up as revenue under the accrual accounting system. We have sales. The inventory of pillows was purchased, and say that was $15,000 for inventory. All right, and we paid that using accounts payable, so no cash left. Again, everything is in balance here. So I initially funded the company with $10,000 in cash. I was able to secure a long-term loan for $50,000 to add to my $10,000. So I have a total of $60,000 in cash. I have sales commitments. I've got sales that I've made on accounts receivable of $25,000. And then I've got inventory that I secured with accounts payable at $15,000. Okay. At the end of the year, maybe I pay myself some dividends, and that will show up as a negative amount because it's reducing the cash balance. And over here, it's $5,000 in dividends. Now, again, it's important to remember that revenues here are a credit balance. This is a debit balance. So in terms of equity, what we have in equity is contributed capital of $10,000. We have revenues of $25,000, and then we have a dividend paid out of $5,000. Now we haven't recorded any expenses here. Technically, the sales here would have had some expenses associated with it in terms of the cost of goods sold. Okay, and so those would get recorded along with the sale. It would reduce inventory. So, and we can actually add that if we want to. So we have cost of goods sold related to the inventory, and so that would be, say, a reduction in inventory. And the recording of, oops, sorry about that, recording of an expense. And I'm going to make this a negative $5,000 just so it's clear. We're not decreasing dividends, but we are decreasing equity. And that's what the negative number represents here. Okay? So what we have is we've got, again, I told you that our, how did we impact cash? Well, the only thing that impacted cash directly in the period is the cash that I gave the company. This is a financing activity. And so I've contributed $10,000 in cash to the company, so that's a cash inflow in financing activities. We have a long-term loan to help finance the company, so that's a financing activity. There are no operating activities that have generated any cash yet or used any cash. And then we have dividends paid. Okay? And so this is going to affect cash. So in the end, we started out with zero cash, and we end the period with $55,000 in cash. In terms of our non-cash assets, we have $25,000 in accounts receivable, and then we end up with, we started with $15,000 in inventory, and $10,000 of that was recorded as cost of goods sold because it was removed from inventory, and so therefore this $40,000 becomes $30,000. And so we have $55,000 in cash and $30,000 in non-cash assets. Over here we have a current liability of $15,000 in an accounts payable, and then we have $50,000 in a long-term notes payable, so we have a total liabilities of $65,000. And over here under equity, we've got $10,000 plus $25,000, so that's $35,000, minus $15,000. So 35 minus 15 is 20,000. And so everything should balance at this point. And again, what you can do is you can strike a line at this point. I'll put a line there. There we go. And I can equals sum, oops, sum the columns. Boom. And then what I will do is down here, I will say equals sum, wrong way, sum okay, and then over here we'll say equals sum and we're in balance. So everything's there. And again, what was our net income for the period? Our net income for the period was $25,000 minus $10,000, or $35,000. That's our income statement. What does our stockholders' equity tell us? Stockholders' equity tells us that we had $10,000 in contributed capital, which could be just common stock. We have retained earnings of 25 minus 10, which gives us 15,000 minus 5,000. So our retained earnings is $10,000. So I think I explained that all correctly, hopefully. At any rate, this kind of shows you how a worksheet can operate to help you in understanding accounting and understanding accounting equations. So rather than talking about debits and credits, you can look at it in terms of a transaction worksheet. And that might be easier for some of you to kind of work through problems, you know, and trying to figure out what balances are. And this also comes in useful if you're trying to understand items in the financial statements. Because remember, say in the balance sheet, you're looking at the accounts receivable, or maybe an other assets account. In order to understand what's in that account, you really need to go back into the notes to the financial statements. And I will show you that in another video. But this is the reason why those of us that are accountants and those of us that are schooled in accounting, we can understand what we're looking at because we understand this mechanism right here, how all this works. And whether it's in T accounts and ledgers, or whether it's represented in a worksheet form such as this, you can kind of reconstruct or gain an understanding for why the balance sheet looks like it does and come up with plausible explanations as to why certain things are happening. And we'll learn a little bit more about that as we move forward. At any rate, hopefully this has been helpful, and I'll get with you on the next screencast soon.